Good morning, everybody. Apologies about the minute delay there. We're just sorting out some technical issues as we get things sorted. Might give it 30 more seconds just while we're sort of sorting some couple of things out here, and then we'll kick off. And I'll introduce our great panelists today. So bear with me for 30 seconds while we just get everything sorted. Okay. Do you know, let's kick things off. So it's 11:02. So first of all, thank you everybody for joining along, and I know people are still coming through and joining. So that as attendees come in, I just want to kick this off. Banjo is very happy to host this our regular economic update webinar. On the call today, we have David Robertson, who's the Head of Economic and Markets Research for Bendigo and Adelaide Bank, and we have Patrick Coghlan, who is the CEO of CreditorWatch. Both gentlemen, and I'll sort of introduce as I get a chance. Sorry, we can't get David's camera working. He is a very fine-looking gentleman, so it's our loss that we can't get to see him today. But we will hear his docet tones as he updates us on what's going on in the economic environment and focus around Australian businesses. I think it's very apt timing that we're looking at this today, as we things start to open up again. We've had 2 years of really hard slog, in a couple of the major states in Australia. There's a lot of issues going on with supply chain issues, employment issues, wage growth. Interest rates, there's a lot of stuff happening out there in the market at the moment, so it's probably a really timely update on what the outlook looks like from a very well read and very well educated economist. So without further ado, we will hand over to you, Mr. Robertson.
Thanks very much, Guy, and thank you so much for that introduction. And yes, apologies that for some reason the technology at my end seems to be struggling a little bit, but it is a real pleasure to be with you all. So thanks very much for the invitation, Guy, and to the whole Banjo team there, the invitation to join you for this update this morning, and great to join Patrick for the discussion. And what is it, 6 or 7 months on from our last update, and look, there's just so much happening in for the economy and throughout the markets locally and globally. So much to delve into in terms of the impact of the pandemic on the outlook for the economy, for really for society living with the virus. So I'll dive straight into it, and I want to share some fairly optimistic forecasts for 2022, which might sound a bit surprising given everything we've been through in the last couple of years. And I think when we're talking 6 or 7 months ago, we certainly held a cautiously optimistic view then, which I think has been the right stance. Not that we saw the Delta strain coming, but we did have the caveat that it was all about vaccines to really complete building that bridge to the other side. And depending on where you're located, and unfortunately I'm located in Melbourne, and it hasn't been a great place, and the photo there of the CBD there deserted, and so somehow Melbourne ended up not just being the most lockdown city in Australia but in the world. I'm not quite sure how that happened, but despite that setback, and similarly in New South Wales, we do expect a very robust recovery through 2022, and really the resilience of the economy was proven last year. As long as you get the policy settings right, I think we can look forward to more of the same next year. So let me prosecute that case as to why we're still cautiously optimistic. And I think the main themes that we need to think about for 2022 and how that's going to be different to this year that we've just got through and the year before is, firstly, demand has rebounded most resiliently. And so I think the issue that we will have next year won't be around demand. In fact, it'll be around supply, and supply is already a challenge through supply chain bottlenecks, through elevated freight costs and delays, and really coping with the rebalancing of the global economy. So we'll have a look at that. and that will feed through to our forecasts for interest rates, given the inflationary risks that come with challenges on the supply side at the same time that demand is booming. As a result, monetary policy support is still in place for next year, but it'll quickly be disappearing the year after. But meanwhile, it's fiscal support that will be wound up more quickly. And so the chap on the left is feeling fairly generous. He's still talking about rates being down at 0.1% until 2024, although I don't actually agree with that timeline. One of us will be right. But the chap on the right, the Treasurer, isn't going to keep his checkbook open indefinitely. And so fiscal support will become increasingly targeted and not the broad-based support mechanisms that got us through the last couple of years. And thirdly, it's going to be a bumpy and uneven recovery. We know that, but we also know that central banks do have a mandate to manage not just full employment, but also to manage inflation. So there will be a recovery, but exactly what that recovery looks like in terms of interest rate movements and the degree of support. So to what degree does the Australian economy need these levels of fiscal support that we've seen over the last 2 years? And moreover, as interest rates rise, what is that going to mean for the property market, which is going to underpin some of the recovery? So I think they're the main themes to consider. I'll use them to build up to 10 predictions for the year ahead. But let me just, before I do that, just a quick review of the 10 predictions that I put on the table earlier this year. And again, there was a cautiously optimistic undertone there, but the China and Asia outperforming certainly been the case from a GDP perspective, but interestingly, the rest of, well, certainly North America and Europe has bridged that gap. COVID vaccines have indeed been the key driver, and that has really explained some of the differentials between growth rates in different regions. I talked earlier this year about the Biden administration and how that will not just drive greater cooperation globally, but also will be part of global reflation. And certainly that has come through over the course of the year, not all of that welcome. And just for the record, we were cautiously optimistic about equity markets as well at the start of the year. So that has played out pretty well, although complicated for the year ahead. So, okay, with those first 5 predictions for the Australian economy, though, the next 5, a little bit patchy. We were right about growth, and we were right about regional economies outperforming. But I must confess, I thought we were ahead of the pack in terms of some of those projections for employment picking up, but we only penciled in the unemployment rate getting down to 5.5, which is more ambitious than the RBA was, whereas in fact it got down to 4.5%. And I also talked about the Aussie getting to 82. Well, it got to 80, but I must admit we've spent the balance of the year trending down to 71, so a clear miss there, even though we were right around commodity prices and we're right around exports holding up. So I can only give myself a B+ there, self-assessed, and a couple of misses, but that's a start. So we'll try and get an A now for 2022. Okay, let's get stuck into the forecast.
David, sorry, just yes. before you head on, sorry, something I should have mentioned in the introduction, guys. If you've got questions, please send them through, and we'll take a break after David's presentation and address any Q&A, and then the same with Patrick. So please send through any questions you have. Cheers.
Thanks, Guy. Absolutely looking forward to debating some of these assumptions and challenging them. But you know, the pace of the recovery, as we said at the start of the year, was going to be driven by vaccination rates, and that is part of the good news now, is that they've picked up. So that does feed through to our baseline forecasts. And I'll run through this pretty quickly. This is a similar traffic light summary to the one we had earlier this year. And actually the colours of the lights haven't changed at all. We're still green for go on employment, even though the unemployment rate did tick up to 5.2%. This middle column here, sorry that the font's a bit small depending on how large the screen is that you're looking at, but the middle column is the latest numbers, whereas the numbers on the right are our forecasts. But let me just pick up a couple of the key lines. So employment, we do see the unemployment rate falling by year end as markets reopen and as economies reopen, but then falling quite aggressively next year. So strong employment growth, therefore a much lower unemployment rate through 2022. And I'll explain why shortly. But we've still only got an amber light there for growth. And that was the case at the start of the year when we were concerned about the recovery being patchy and uneven, a lot of variance within industries and by industry. And of course, the quarter we've just finished has been a contraction thanks to the Delta strain. But nevertheless, we do expect reasonable aggregate growth over 2021 and then 6% year-on-year growth for next calendar year. And again, that's going to link back to the reopening of the economy in terms of those restrictions and tourism, as well as jobs growth. Confidence has been resilient throughout the year. We'll have a look at a slide on property, where property prices are up over 20%. We're a little conservative on some of our forecasts there, but I think it is worth noting that property price increases will be much lower next year. Trade obviously has been complicated by the trade tensions with China, and also with the rebalancing between service exports and goods exports. But nevertheless, we're running a strong trade surplus. And you'll note that the one red light in this summary is for inflation, where the inflation rate had been much too low for the Reserve Bank's liking, but equally I've got concerns that it might get away from them on the top side, and I'll explore some of those themes. So there are our baseline forecasts, relatively optimistic and mainly driven by the jobs market. So why do we think the unemployment rate will fall aggressively next year? A, because it did so last year, or last financial year, prior to the Delta strain. And secondly, because we've got these record levels of job vacancies, decade highs for job advertisements. And basically there is really strong labour demand out there. And I'm sure most of the businesses online would vouch for the challenges in accessing labour, and part of that's being driven by international borders being closed. So good news that we expect strong growth next year. I think it's almost worth just a bit of a reminder of what exactly have we just been through. It's all been such a surreal period, and you know, I think we need to remind ourselves that we just have been through the largest hit to global growth pretty much on record, even more so than we experienced during the GFC. That was meant to be a once-in-a-century event, and we've had another one. But importantly, the recovery to pre-pandemic levels of GDP is forecast, whereas we never really recovered from the hit from the GFC. So they are very different sort of economic shocks. For Australia, we had the initial hit of a 7% decline in GDP, all fully recovered. And now we're going through the second double dip, if you like, and that's now in the pink line. That's the latest RBA forecasts, which I think are spot on there. And therefore, what have we been through? A massive economic shock followed by a recovery and now a second dip. We are now here, just at the bottom of the second V. And so 2022 should be this period where, again, the economy recovers and responds to all the stimulus measures that have been put in place. How much stimulus has been put in place? Well, the federal government have declared it as $311 billion. Throw in some state government money as well, you get close to $500 billion. But I think that $311 billion number that the government cites is important because government debt over the same period has increased by $265 billion. So it's almost entirely been funded by debt and not by taxes. And here's a coincidence, the Reserve Bank have bought $310 billion worth of debt over that period. So the stimulus was funded by debt, and the debt has indirectly been financed by the Reserve Bank, which I don't have a problem with. But it is worth pointing out that it's basically quantitative easing, the printing of money, that has created the financing of the debt. Fortunately, that money is being put to productive purposes, so I see a happy ending with all of that, and we retain our AAA credit rating, so international ratings agencies aren't worried by it either. But I do want to highlight that this has driven a strong wealth effect, and it almost sounds perverse or almost counterintuitive that on average net wealth is higher today than it's ever been. But that is the impact when you throw about $300 billion of government money or federal government money at the economy and another couple of hundred from state governments. Dwelling prices have never been higher. Assets have never been higher. Think about the average super fund making about 20% last year. And meanwhile, debt levels have actually fallen because of record interest rates. That's on average. Obviously, there's a lot of divergence by location and by sector, but that's the wealth effect that should drive the recovery. And just to emphasize the point, there have been a number of economists' estimates of household savings being somewhere between $230 and $260 billion. So that is money that has been accrued and is waiting to be deployed. So that's what we've just been through. One of the other things that we've managed to achieve to add to that positive story is much higher vaccination rates. And I was very worried about this earlier in the year, and can't say that the federal government made a great start to the year around vaccinations. But fortunately, no offence to the politicians involved there, fortunately, we have bridged that gap entirely. And so at June 30, we were only at about 7 or 8% of the entire population fully vaccinated. And now look at the numbers, and we're just about to, I think we've just hit 81% of the adult population fully vaccinated. So we've gone from behind most countries to actually being ahead of many, including the UK, the US, and Europe. And that does matter because, what we're seeing globally is that countries with high vaccination rates are seeing, sure, an increase in case numbers as they reopen and as we become more sociable and mobile, but not an increase in the mortality rate. And unfortunately, the converse is true for countries that haven't been able to achieve high vaccination rates. So I think that's one of the key differentiators, and that's one of the key reasons that we have a strong GDP outlook for the year ahead, just the fact that we have bridged the gap on vaccines. Maybe I'll just fast forward to, just a quick comment on inflation, and this is a global survey from McKinsey. Just a couple of months ago, the main thing we were worried about was the pandemic, obviously, and the impact on GDP. All of a sudden, a higher percentage of respondees to this survey are more worried about supply chain disruptions and inflation. So there's been a sharp change in focus, and fortunately, I think Australia's ability to cope with inflationary pressures is probably going to be slightly easier than elsewhere, but we're seeing all around the world increases in headline CPI. The US had their print the other day at 6% for the headline and 4% for core inflation, and it's really no different anywhere else. Sharp rises to CPI, to core inflation, to PPI, to producer prices, all much higher than they've been for decades. You really have to go back to the early 70s to see a similar situation. So I don't want to labour the point, but there has been a bit of a perfect storm for inflation via high energy costs, oil price at a much higher level than it's been for a while, higher input costs, shipping costs, and so on. And so no wonder we've got inflationary pressures, and that's even before you consider labour shortages and pressures that might come through there. So that's the global backdrop, somewhat complicated. What about here in Australia? How are the Reserve Bank going to respond to those inflationary pressures? And certainly the Reserve Banks have been, or the central banks have been all in on their bond buying and on zero interest rate policy settings. But if we look at where that's all heading now, so there's the US forecast to increase their rates next year. New Zealand have already started putting up their rates, and we expect actually a 0.5% increase from the Reserve Bank of New Zealand later this month. Japan and Europe are outliers, but comparable economies to Australia like Canada, even the UK are likely to increase their interest rates next month. Here, the Reserve Bank, well, they've still been towing this line of no hikes until 2024. And you can see what the yield curve is pricing in there. Actually, 2 hikes next year, even a third up to 1% by early 2023. But I'd suggest this dotted line is more likely where we have a more gentle increase in interest rates. So I'm suggesting that the Reserve Bank will need to have their first increase to official interest rates in a year's time, Melbourne Cup Day next year. So that is 2022, and then gradually getting to 1%. Whereas, as I mentioned earlier, the head of the Reserve Bank, Philip Lowe, is actually saying not till late 23, early 24. But I do think that, as well as considering the official cash rate, we do need to keep an eye on fixed rate lending. And I recall saying 6 or 7 months ago when we last caught up that might be your last chance to lock in debt. Well, that is the case now because these swap rates are about 1% higher. So fixed rates are definitely on the rise, and that is a challenge to property markets, albeit that they're still at relatively low levels. So look, just let me race through the last few slides before I get to my conclusions. On the property market, you'd all know, depending on where you're located, just how strong things are and how unaffordable some parts of the property market have become. The outperformance of regional Australia to the rest of, or to the capitals, has been well documented, and I don't think that trend is going to change in a hurry. But if I can just quickly look at some of the key numbers from CoreLogic's website, interesting to note that the average price of a regional property has risen almost 25% in 12 months, whereas for the capitals, it's up just over 20%. And then you look on a state-by-state basis, and Melbourne's been one of the laggards for obvious reasons, but some of the other increases are remarkable, with Hobart up 28%, Canberra and Sydney over 25%. And again, look at some of the regional prices. And so really all I wanted to say around property is, firstly, I do expect regional to continue to outperform. But secondly, I do expect the pace of property increases to really moderate quite quickly, especially as we get closer to rate hikes due to the inflationary pressures that I've just talked about. And in many respects, the rise in property prices, it's more been an issue around equity and affordability, and a good example of inequality coming out of the pandemic. I don't think it's an issue around debt and bubble risks, because interest rates have been so low, and even with rate rises, these numbers are likely to remain quite manageable. So that's property. The overall commentary I'd like to give around the outlook for consumers and for business is still one around the V-shaped recovery, but unfortunately V plus a Delta outbreak has made a W. But nevertheless, we see consumer sentiment being pretty strong through the end of this year and into 2022. Obviously, some complications with the states that haven't had outbreaks but will be reopening their borders to scary places like Victoria and New South Wales. So how they're going to manage localised outbreaks in those states. But nevertheless, we see a continued improvement in business confidence, responding to the pent-up demand that I've just talked about with household savings. Again, the V shape became a W for Victoria and New South Wales. For the rest of Australia, it's been a little more balanced. But our view is that business confidence will remain firm going into year end, and we need consumer sentiment to be strong so that savings are spent. We need business confidence to remain strong so that business investment continues to pick up, and it's actually at a pretty elevated level, notwithstanding the last couple of years in terms of investment in machinery and equipment, and some of that relates back to government incentives to invest. So I think they've been quite effective, those incentives, and if we're correct about household demand driving that sentiment, then that should make for a positive outcome. The only other comment I wanted to make around business conditions, though, is yes, there's been a sharp increase in spending on goods, but it's been at the expense of services. So for next year, you'll see the services consumption skyrocket. Goods, I think, will remain above their long-term average, but it's going to be a rebalancing there. So some complexities dealing with that rebalancing. Let me just move on quickly to equities. I don't really want to dwell on this too much other than to note how strong the recovery has been, especially in the US. Japan and Europe lagging to a degree. What about Australia? And It's a slightly scary chart, I think, when you look at the ASX 200, our main index, which has gone from 6,000 a few years ago to 7,500. Not bad, about an 8% return if you throw in dividends, whereas the NASDAQ has gone from 6,000 to 16,000. So, if you're looking for a bubble, candidate, I think it might be in some of those higher valued tech stocks. But there's probably no getting around the fact that Australia has lagged due to, a lack of innovation in our top 10 equities. 35 years ago, 4 major banks and a minor, and today the 5 largest stocks in Australia are 3 major banks and a minor, as well as CSL. So that need to continue to innovate and to leverage technology and to be positioned for demand of the future, I think, is evidenced in that chart. And just finally on the Aussie dollar, look, if the Aussie were tracking commodity prices, we'd be up at 90 cents. Commodity prices continue to perform commodity markets continue to perform very strongly. But I think the main reason we haven't followed commodity prices higher is because of not just the trade tensions with China, but also the slowing Chinese economy. And I think some of that also links back to the geopolitical tensions through AUKUS and maybe through the Quad Alliance as well. But my simple equation for the Aussie for next year is, based on commodity prices, it should be higher. And that's why we continue to suggest the Aussie trending up to 80 cents plus. But given the slowing Chinese economy, still growing, it's just decelerating, I think that's probably the main inhibitor to the Australian dollar and to some of the cross rates, and also linking back to the Reserve Bank positioning itself at the back of the queue with respect to central bank rate hikes. So look, just to summarise that, why are we optimistic? Well, because of the high vaccination rates that I've talked about, because of accrued stimulus. I've mentioned the $260 billion in savings that hopefully is waiting to be deployed, because of high vacancy rates that should drive demand for labour. I think that's already there. And as I said before, because of healthy household balance sheets. So they're the main drivers of our confidence. If I just put that into words with 10 predictions, China decelerating, Europe and the US fairly well placed. Don't bet against the US. Global reflation underway, which is a comment that I made at the start of the year. Equity markets supported, but inflationary concerns growing. So growth of 6% we're forecasting for the year ahead. Unemployment down to 4%, which will be lowest level it's been since the 70s, if we can dip down to 3.9, which is our forecast. Aussie up, property to remain in demand, but rate hikes to come into focus, and commodity prices to also remain in demand, and that should help with exports, notwithstanding the decelerating Chinese economy. So bring on 2022 is my quick summary. So look, I'm out of time, but look, thanks again, Guy. There's my disclaimer, just for the record. But I look forward to answering any questions on those forecasts.
Cool. Thanks a lot, David. That's great as always. We do have a few questions coming in. There's a few that are sort of around the similar ilk, so I'll try and group a few together initially. So around the savings rates, your recovery to forecast GDP has been driven by demand. And at the moment, sort of stating that there's about 20% more cash being hoarded. I think it was on the ABC this morning.
Yes.
Do you see, the savings rate returning to some form of normality, or is confidence still a way off from that happening? If you're saying it's driven by demand.
Yeah, it's a good question, because all very well to say there's lots of money saved and therefore things will be sweet, but what if that money doesn't get spent? So I think that does link back to consumer confidence. I think the reopening of state borders is going to be crucial in that, and that's why high vaccination rates are so important, because that's the only way we can reopen state borders. And I've also got more confidence that international borders will be reopened more quickly. I see that, as well as the New Zealand travel bubble, a Singapore travel bubble is imminent. And so I think that will drive the spending. The household savings ratio, which is normally about, I think, 5 or 6% of disposable income is saved. That's shot up to about 20% initially. It's back down to about 12%, but I see that falling next year as basically as households make up for lost time and deploy that capital. I do think they'll deploy it more so through services than just through goods. But yes, I've got confidence that the household savings ratio will fall as you know, as we become more mobile, as restrictions really become a thing of the past, and in line with increased consumer confidence.
Yeah, good. Yeah, good. I think we've all come pretty good at spending on goods, David. I know my online purchases have been up, so I'd imagine a lot of the service companies are pretty keen for that rebound to happen for them as well.
Absolutely.
Couple around the sort of government here to finish. The government stimulus, in your mind, is it money well spent or is it too blunt? What's your thoughts around that?
Yes, it's a fascinating question, because I know the Treasurer, and the government has been really put to task around JobKeeper and just how broad it was, and well, what about businesses that ended up being quite profitable through that period, and why were they able to avail themselves of it? And then, you know, the questions around transparency on all of that. My personal view is both that it's important that the government did embrace fiscal policy for a Conservative government to run a budget deficit of, $160 billion last financial year, and then another 100 billion this financial year is pretty extraordinary. But they needed to give the economy the support that was required. So, look, could they have made that JobKeeper and other support packages, Home Builder and JobSaver and so on, could they have tailored them better? Probably, but I think compared to other countries around the world, our the rebound in employment has been testament to the effectiveness of those policies. So there was probably a bit of a trade-off between them being a bit too scattergun and broad-based and not sufficiently targeted versus the urgency in getting them deployed. And the other part I'd say is, sure, our debt levels have risen as a result of this, but we're still one of only 6 countries in the world with a AAA credit rating from each of the 3 major ratings agencies. So we've been able to afford those stimulus measures, and we saw the V-shaped recovery last financial year. I think you're about to see another one in the year ahead, and for mine, that is mainly because of fiscal stimulus as well as vaccination rates and the RBA support.
Yeah, great. Okay, that makes perfect sense. Thanks, Dave. All right, maybe last question before we move on to Patrick. Using your crystal ball, David, we've got a federal election happening next year. What are your thoughts around that?
Oh, wow. Well, firstly, when should we expect the election? Probably around March. I think they probably had half a thought of going in November, but then when things didn't go quite so smoothly on a few of those factors, they pushed it back. The bookies markets are pretty much even money each or two. So I don't think there'll be a lot in it. It will be fascinating to see what both sides are, what their platform is going to be. Obviously, the Morrison government is kicking off with economic credibility. I'm not sure that climate, that the COP26 went that well for them, but at least they've got a commitment to zero by 2050, net zero. So let's see what the policies are like. I think it's going to be really close. Interesting to see the state government elections, though, where the incumbents did well via their management of the pandemic. So what's the voting public going to think about the federal government's management of the pandemic? It had good parts and bad parts, in my view.
Yep. Yeah, it certainly did. I think we've all got a view on that one. I just, that question sort of might have thrown you under it a little bit, but it's pretty fascinating. It's going to be a pretty interesting 12 months ahead for the federal government, I think.
Absolutely.
Yeah. All right. Hey, well, thank you very, very much, David. Great as always for that insight. I'm going to introduce Patrick now. Patrick is the CEO of CreditorWatch. CreditorWatch have just recently come out with a really new, amazing sort of risk index, business risk index, looking at business confidence around Australia and where there's defaults and what type of businesses are doing well, and geographical breakup. But he's going to probably put a bit of a forward prediction on that, I believe, Patrick, for this one. Oops, you're on mute.
Yeah, look, I think, can you hear me?
Yep, got you. Yep.
Excellent, thank you. Yeah, look, I think there'll be some really good links between this presentation and what we just saw as well, which is nice, particularly around the regional areas outperforming, the capital cities. And look, some people may have seen the risk index, and this is looking at October results. So I'll touch on some really good insights, and then hopefully that generates a bit of a discussion as well. So just very quickly, that the risk index is a new economic indicator that essentially is measuring the future insolvency risk of about 300 odd, or a bit over 300 regions across Australia. So essentially it is ranking the best performing regions all the way down to the worst performing regions from a probability of default or the probability of insolvency of a business within that particular region. We're also looking at sort of national, state, and of course individual business levels. I'll touch on some industry information as well, looking at how certain industries are paying their bills, and of course the probability of default of specific regions, specific industries too. How are we putting this all together? CreditorWatch is a commercial credit reporting bureau, so we're collecting data from 50 odd public, private, and government data sources, including ASIC, AFSA, Australian Business Register, court actions, and whatnot. And then on the sort of private side, the proprietary information that we're able to capture, we've got over 55,000 companies across Australia using us for credit reporting requirements. So they want to check on a business before they grant them trade credit or finance or a loan, for example. So the data we get from those, we're able to, we get a great network effect where we can see debtors paying multiple creditors, and then able to sort of report on that particular one. So the business risk index, you can see here the regional credit rating. So you can see that the regions themselves, obviously some big giant ones where there's a lack of businesses, but then when you start to get into the capital cities, you start to get sort of 30 or 40 odd regions making up those areas. It's calibrated on about 1.1 million ASIC registered credit active businesses. And we've obviously gone back sort of, I think, 5 or 7 years to actually calibrate it and make sure we've tested it and are extremely confident in its predictive abilities. From a model perspective, two main predictors or sources of data. We've got the CreditorWatch data that's coming in. The real key driver there is the transactional information. So we're able to plug into Xero and MYOB and accounting software providers, or get access to age trial balances and see how businesses in particular are paying their bills and how that's trending up or down over time. And then we're looking at more structural predictors or economic indicators such as socioeconomic variables, rental and property prices, and of course personal insolvency too. So with all of that comes together in a beautiful model, and we get the business risk index. And what are we seeing ultimately? So the first point here, and it was one of the first points that was made as well by David, was regional is certainly outperforming urban and city centres, which is great to see. And you see that not just across business strength, but of course we saw that in the property price slide as well. The main weak performing areas, there's been serious deterioration capital cities, particularly on the seaboard, in order of worst to less worse, I'll call it, is Melbourne leading the way, unfortunately. Brisbane and then Sydney. Obviously, having been in lockdown the longest out of any city in the world, is probably not a surprise. They are really struggling. There's been a big drain as well on businesses and people moving out of Melbourne too. The other thing that we've noticed is a fairly obscure fact, is that Melbourne used to be the startup capital of Australia, and that has certainly deteriorated, and we've seen Brisbane pop up as the sort of startup capital in Australia as well. So, you know, I think the pressures of the cost of living in Melbourne or Sydney, for example, is certainly not ideal if you're starting a brand new business and are expecting, you know, very limited income in the short term. Queensland tourism industry has taken a huge hit, and in particular the Gold Coast Coolangatta area is really struggling, and that's one of the worst regions in Australia. All of the regions that sort of make up that particular area. The pressure on them, of course, is that, you know, borders have been closed domestically for so long, but there's an argument to be made that domestic tourism alone won't be enough to get it back to where it was. It's very reliant on that international tourism too. Western Sydney as well is probably the second worst region from a performance perspective, and that's looking at sort of Canterbury, Bankstown suburbs and surrounding suburbs there. They had a really, really tough extended lockdown that put a lot of pressure on them, but they have traditionally been one of the riskier industries as well, with some obvious factors in there, high rates of personal insolvency, but still being in Sydney, there's high property prices too, whether it's commercial or residential. From a strong performance perspective, agribusiness is doing really well, which is great to see. There's obviously been a lot of pressure on ag as a whole, and I know that's a very big industry, and it's across Australia. But, you know, there's been, you know, floods and fires and droughts that have absolutely hammered them over the last, you know, 5 to 10 years, to be honest. So it's great to see that particular industry performing nicely. In particular, Mackay, the WA wheat belt, and we're seeing really positive data coming out of like wine growing regions, despite of course the tariffs and the bans put on exporters into China, for example. Green energy regions are also among some of the top performing regions in Australia. Griffith with the Darlington Point solar project, and also SA Mid North, which has the Hornsdale Wind project too. Manufacturing, which is great to see, certainly not dead or dying like it has been labelled over the last few years, is outperforming most of, you know, states. So where you have a manufacturing region, that is certainly outperforming the rest of the state, which is great to see. The last point here, insolvencies, and I'll touch on the numbers. We'll look at the numbers in a little bit more detail later on, and also payment defaults. But insolvencies, you know, the third most reported on number over the last 20 months after vaccination rate, and of course case numbers. Most people were expecting an influx of zombie businesses and a wave of insolvencies. You know, I'm certainly on the record for saying that was coming, but with the tremendous amount of stimulus that's been pumped into the economy, and that continued stimulus that has been supported, particularly JobKeeper, all the way up until March, when there was expectations that it might come off in August, September 2020. You know, that has put a huge amount of synthetic liquidity into the market and supported plenty of businesses. But we will touch on those numbers in a little bit more detail. So best and worst performing regions. So the 5 areas at least risk of credit default or failure in the next 12 months: Murray River, Swan Hill, Vic. So obviously nice regional. We've got another one there in Glenelg, Southern Grampians, Limestone Coast, Moree, Narrabri, and the Grampians as well. Top 5 at greatest risk of default: Coolangatta, Canterbury, Bringelly, Gold Coast, and Maryland. So all within that Coolangatta and Western Sydney part of the world. Average PD by state, average probability of default by state. you know, the top performer and the worst performer has remained fairly consistent, and this is going back to Jan 2018. You're seeing up the top there, Queensland has traditionally been the riskiest state from a commercial perspective, so right up there at 6.2%. We've seen that climb out of early Jan since the pandemic hit. The other big mover you see there is Victoria, traditionally, you know, really strong performer, but you've seen a big increase, and that started, to be honest, prior to COVID hitting. So you can see they've been on a general sort of upward trend line from sort of mid 2019. New South Wales has remained fairly steady. WA as well, being more of a boom bust economy, somewhat up, somewhat down, and then it's trending down. They've done a great job, obviously, of keeping case numbers low, taking advantage of course, you know, commodity prices and commodity activity, and also just being able to get back to a normal trading rhythm internally, without any of the eastern seaboard or the rest of the country coming over into WA. Trade receivable contraction. So this is a really great slide that we've been utilizing for the last few months. Essentially, what we're able to do, as I said, we're plugged into, you know, accounting platforms and payment systems, able to see, you know, what sort of turnover businesses are doing and how that has changed over the last almost 5.5 years, back to Feb 2016. So you can see right through the middle, this is the zero growth line through here. So, you know, very, very strong year-on-year growth. But what we started to see is a deceleration of that growth in late 2018 and then through 2019. And of course, late 2019, we had fires and floods, in particular, you know, on the East Coast that really hurt the economy. We also had New South Wales and federal elections, which typically slow down spending as well. And of course, then we got hit by COVID. So we went into it slowing down somewhat. And this is essentially looking at the turnover of the average business as a small and medium business. JobKeeper filled a big hole as revenue and turnover dropped away quite steeply. But once that free money tap was turned off in March, we've seen it just continue to drop away. And we look at year on year, 37% down, which is a huge gap, a lot to make up. However, like the previous presentation, myself and our data science and analytics team are certainly positive and optimistic about the future, despite some of these graphs looking quite scary. Now, if we look at a probability of default by industry perspective, what are we seeing? No surprises that the worst performing one there, food and beverage services at almost 6% probability of default in the next 12 months, followed by arts and recreation and education and training. At the opposite end of the spectrum, we're seeing mining, manufacturing, wholesale trade, ag, you know, primary industries, which is great, and also healthcare performing really nicely. The one I will call out is construction. There's a lot of discussion around construction at the moment. We don't have them as being very high at this point. I think December, Jan will be really interesting to see how projects proceed and how they get back on track after plenty of delays in that space. And we know that delays in construction mean, you know, a lot of cash flow issues up and down the supply chain. They're also very reliant on progress payments, whether that's from a lending perspective or just from the end customer. And then that pushes out, of course, into the subcontractors. You then have the additional challenges of, you know, big increase in the cost of materials and also delays from supply chain issues. So if they get their quoting wrong, if they're extremely reliant on a job being finished to get paid, you have big blowouts, and there's obviously been a sizable one that's been reported on in the media recently up in Queensland. Privium, I believe it was called, you know, 20 odd million in debts. So there certainly will be, as we know, some big ones. But despite that, we're not calling them out as one of the worst. The sort of flip side of that is this graph is looking at the payment arrears by industry. So essentially, the number of business or percentage of businesses that are paying 60 days overdue on average, and construction is the leader there. They're very often the slowest paying industry. However, they are consistently slow. The question will be, because it is, you know, razor thin margins, if it pushes out too much further, or there's too much of a shift, then the probability of default of construction will change quite quickly. Second and third there, food and beverage services, and then transport, post and warehousing, retail trade as well coming in fourth, a really important one to review there. They are hanging out for, of course, stores to reopen and people to come back in. Big e-commerce boom, of course. If you had an online presence, there's been, sort of 5 to 10 years worth of online adoption in the space of, 18 months, which is great to see. But if you didn't have that online presence, you were certainly left behind. Conscious of time, I think this is the last slide that I'll show. External administration. So if you come back to Feb and March, they're sort of normal numbers from a month-to-month number of external administrations or insolvencies. Of course, December, Jan are always lower. We never really got back up there. There was a bit of a rush in December, a bit of a rush in June, but certainly just came right back off. False positives, that I call them. When a lockdown occurs, the number of insolvencies drops, which is somewhat backwards. The big question mark is when will the ATO in particular, and also the major banks, get back into their normal collection rhythm, where they're winding companies up who can't pay. The fact is that they're doing their collections, and the ATO has come out and said, or it's been reported that the ATO is starting to put a bit more pressure on and start to collect a bit more from small businesses in particular. But the question mark is ultimately, when do they start winding companies up? Until we start to see the major banks and the ATO winding companies up, we won't see a big increase back to pre-COVID levels, but it has to happen eventually. And we're sort of expecting that to happen mid next year, where we trend upwards and get back to normal numbers of external administrations. So if you've, after further information, you can go to creditorwatch.com.au/business risk. And if I can get this right, you can actually jump in. Guy, can you see my screen with the map of Australia?
Yep, certainly can.
Fantastic. Yep. You can actually jump in and see an interactive map and see all the little regions. And if you want to go right into Sydney and see obviously Western Sydney, you can see this darker red area, Bringelly, Penrith, Camden, etc. You can then see it from a state by state breakdown. There we go. Sorry, Queensland, blah blah blah. And you can get in really into the numbers if you want to get into it. So I encourage everyone to do that. Otherwise, we're always free for questions, and I'm free for questions now as well if you'd like to go that way.
So we've got a couple in here, Patrick, but first of all, thanks a lot. Guys, the CreditorWatch Business Risk Index, it's well worth checking out. So it's free and it's available, so please do check it out. There's some really nice insights in there. Patrick, I did have a couple of questions that came in around the insolvency that you've really covered off around your thoughts around the ATO and banks sort of calling on things, and that's probably something for us too here as a working capital lender and to businesses. It's just understanding what that future is going to look like. But I think you kind of answered in your presentation, so I won't go into that. The one that was interesting for a couple of people was the Brisbane, Sydney, and Melbourne in particular. But Brisbane was worse off than Sydney, yet they had no lockdown. Is that through, as in sort of arrears and defaults? Is that just historical playing out there, and like the startups, is that having an effect on that? There's more increased startups. How do we sort of interpret that data?
Yeah, look, I think Queensland has traditionally been just a. Can you hear me? Might be my internet.
Yep, good to go.
Guy, can you hear me all right?
Yep, good to go. Good.
Right. I'll just stop sharing it. That might be my internet. So what we found is, Queensland is traditionally, a tougher place to do business, or there's been a higher probability of default there pre-pandemic as well. So, that's probably not necessarily a COVID affected reason as to why they're struggling, but they've also been somewhat left behind with their borders being closed. They're reliant on, you know, trade with New South Wales and Victoria as well, so that's put additional pressure on them.
Okay, that makes perfect sense. Thanks. The one thing there's arrears which some couple people found interesting was transport, postal, and warehousing. The arrears were high. Yet I would have thought, as other couple of people did here, they would have been the industries that are booming. Any reasons behind that?
Yeah, usually I actually explain that when I go through it. It's because it's one that time, and I think it's a really big industry, right? So there's question marks over, you know, a better job of, you know, the ANZIC code looks at the top level industry, right? And it's got transport, postal, warehousing all jammed in. You think about transport, Qantas, Virgin, Rex, Greyhound, trains, no one is traveling anywhere. So that one little part of those three words has been totally decimated, and there's some really big money in that, of course. You know, warehousing is doing well, no doubt. You know, Afterpay, Zip, Coghlan and whatnot have done a great job of filling warehouses and also the transport. The other thing to look at though is, you know, there's been a huge adoption of e-signatures, for example. So even, you know, within CBDs, the couriers, for example, that spend a lot of time delivering things have now, you know, essentially lost all those jobs where it's either being done by DocuSign or AusPost has taken over the delivery because it's more residential rather than it coming into town.
Yeah, okay, fascinating. Yeah, very, very fascinating, that last part. Look, probably in the interest of time, we'll just have one more question. How often is your data being updated for the risk index? And you know, will you be going to live updates at any time? And just where does the future go with this? Yeah.
So the data that we're collecting is live, but we're reporting on a monthly basis at the moment. So that if you were to go to the website, that'll be the same data through to sort of mid-December. I think it's the second Tuesday to release the previous month's stats. So second Tuesday in December we'll release the November numbers. I'm certainly pushing it to move. We don't have James O'Donnell, who's the Managing Director of Open Analytics. We don't have Jeff, Managing Director of Open Analytics, who we use for the model. He's probably sweating somewhere data to obviously, I know Patrick's talking about live. There's a lot of the process, but yeah, look, at the very least, I think we'll start to report figures, and then from there, hopefully start to move to, you know, potentially fortnightly, weekly, and you know, if I have it my way, live, it'll be up eventually.
Okay, very good. Well, let's hope you get your way, Patrick. All right, look, just to wrap up, look, a really big thank you to David for running through his economic outlooks for where we're going. It's a fascinating time, I think, for everybody who's involved in business at this stage, what's happening out there. Patrick, thanks for your update. Everybody on the line, thank you very much for participating in the questions that came through. Yeah, it was great. All right, everyone.
Sorry, I'm still here. I've just turned off my camera because my internet was playing off. So thank you for having me.
No problem at all. No problem at all. It's always good. Everyone, please look, enjoy the weekend. Any questions, please shoot them through to us too. We can shoot them out to David or Patrick if required. But thanks for your time. Looking forward to a really good 2022 for everybody. All right.
Yeah.
Have a good day, guys. Cheers.
Thanks, Guy. Thanks, Patrick. Cheers.
No problem, David.
Yes.